Hey trendsetters, It's Monday night, so you know I'm here on Financial Conversations with Phill Benn. Tonight, Phil and I are going to be talking about some investment terms, right? Previously we had went over some terms that were basic financial terms. Well, now we're going over investment terms. And we'll tonight the floor is all Phil's
Oh,
again. So good night, Phill. Good night.
good night, Heidi, good night, trendsetters. We're here ready to dive into some more of the terms, the terminologies when it comes to investments. And we're going to start. I really want to start with what matters to most people, which is the term bonds. Uh, And why we're starting there is that when it comes to building a bridge, the government issues bonds to
Oh,
build a bridge.
okay. So you're saying like structure and things like
Yes,
that. But that's
yes, right. So those are the base, they're gonna build a bridge, they're gonna build a new highway, things like that, infrastructure.
okay.
Yeah, so you to raise that money, the government will issue a bond. So a bond, uh, so so a bond is like a share, but generally it's only mostly relates to what non-for-profit organizations would use. Like, so the government is not like a for-profit, but also a company can issue bonds as well. They A company will issue bonds or they'll issue stocks to raise funds to expand or grow their business.
Okay. I gotta stop you. Right. Back in the 80s, you could have bought a little $50 bond, a little $25 bond, them type of bond, right? Saving bonds is what they used to call them, right?
Correct.
Difference.
So, well, those are savings bonds, yes. A savings bond,
Hmm.
that's kind of different from, there's a slight different from that from, because with a saving bond, when you buy a saving bond, you're buying you actually, I don't know where that money is being used for, but in general, you're buying a bond because you know that the return that you're getting on that is going to be safe,
Right.
regardless of, it's safer from fluctuations in the market. So a stock can fluctuate in the market,
Okay.
right? But if you want something that is long term and you
Hmm.
know it has steady growth, so if you
Right.
know it's going to be a steady growth for like 3 or 4 or 5%, you know you're going to get that,
The interest is what's growing on the bond.
right? And
So
it's
it
not
much.
going to be impacted by fluctuations. So that is guaranteed return at whatever percentage you had gone into contract for. That is a guaranteed. So that's why for some people, especially for older people,
Yes.
bonds are the way to go for them. They want something safe for a period of time, right? So yes, so back in the days, yes, you know that you bought like a gift for a child, you know that that is going to mature at a certain time. So like if you know like like if the child is just born and you know that you want to buy a bond for X amount of period of time and you know it's going to grow and mature at a certain time so that that money is going to be there for the child and you know I'm going to buy this bond so that when it's time for them to go into college, there's the money. So
Okay.
that's a bond. But generally we know that when bonds are issued, it's always or more used for raising money to do infrastructure. So the bridge that was just that they had that accident where the runaway cargo vessel knocked it down.
Mhm.
Right. So there, that would have been a great way for people to make some money, was to have purchased the bonds to rebuild.
Doing that infrastructure, that
Right. Yeah, that was one project that had to be done. The money had to be raised. The bond issued. That would be what a safe place to be to say I'm going to buy that bond. And as you hear all of this talk about right now, the former administration, they were talking about all of the bridges and everything needed work. Where's that money going to come from? Regular taxpayers now have a chance now to invest their dollars into and buy these bonds and make some type of a return on that investment.
yeah, on that interest, right?
Yes. Mhm. So
Wow. Okay.
so they use bonds to build, to raise money for a lot of different things. So, and also investors are using bonds as well. So that is like um a company can issue a bond as well. So we're talking about New York State could issue a bond, or New York City could issue a bond, or like if you go out in like Long Island, you have different communities, or what they call Long Island. So Long Island has different communities where they could issue a bond just for certain things that they need to have done.
Like what?
I guess to repair, like a school.
So you can
Yeah,
raise, you
yeah.
can you can create a bond
Hmm.
for schools, for staff,
Yeah,
or whatever it
right.
is. That's
If it's a private school, they could figure, and they want to raise some money, they can definitely you have corporate bonds, which is issued by companies to finance their operations or projects.
right.
You have
Okay.
government bonds, right, issued by state or local governments, right? That is to fund projects, right, or operations, right? And like I said, municipalities,
Right.
right? So your Nassau County is separate from a different county, different counties or municipalities,
Mhm.
right?
Mhm.
So you have the face value, right? So it's normally like $1,000. So you can buy $1,000 bond, and then there's an interest rate paid on the bond. And the bond has a maturity date, which means, like we were talking about, like say, a certain time period.
Right.
So yeah, I want a bond and I want it they offered, it could be 10 years, 20 years, okay, 30 years, okay, I'm gonna buy that. So you know that at that maturity date, there goes my money.
Right. Okay.
And then you have, your bonds versus stocks. So a stock is an ownership in a company. So you name any company. So you could buy a McDonald's stock, or a Tesla stock, or Google stock. You can buy a stock in just about any company right nowadays. You can buy Wendy's, you know.
Right.
So
Right.
basically any product, most of the products you see out there, they belong to some of them
Stockholder.
belonging to a company, and you can buy the stock in that company. So, and that's when a company is launching. So, okay, for example, Heidi, you're launching
Trendsetters.
Trendsetters. and you form your corporation and you issue stocks so people can buy stocks in your
Right.
company. So if your goal is to raise $1 million, right, then you set a price per
For your
share,
share.
for
Mhm,
each share.
mhm.
So, and that's the basis of how this stock market works. And then of course, you have an issuing date, but there's a review, right? So you can't just create a stock and just put it. You go through a review process, right, by a governmental agency, and they're the ones that are going to. You can get a rating. There's also penny stocks as well,
Right.
right? So you got penny stocks, and then you have from there. That's for people who have a small little company. So you have a little penny stock. But then again, once your stock is established and it starts growing in value, you know where I want my stock. So penny stocks is like a $5 and below,
Yes.
you know. But if you're gonna launch a product and you know as the company and the developer
Right.
of the product, you
The
can set
realistic projections, right.
right. Yeah, so that's called like a prospectus that you have to give the people who are looking to buy the stock. You got to give them a prospectus, and then they review the prospectus, and then they say, okay, all right, it's worth my money, and so that's the stock.
Okay.
So, but all of these transactions are done on the stock market. So now the stock market is where every company that is looking to raise capital for their business would issue their stock.
Say that over.
Yeah, every company that is launching a business and is looking to raise capital,
Uh-huh.
they will issue their stock on the stock market where everyone can purchase a stock, be it a child who's got, you follow what I'm saying, whomever, if they want to buy a single stock, they could buy a single stock. Or a major investor could go buy 10,000 shares or 1,000 shares based upon their financial means. Everybody, it's
I got
open market for everyone.
right. So it's like Amazon for stocks.
Correct. If you want to use, yes, as an Amazon for stocks, because every type of stock is there.
Because
So
every
that
type of stock is there,
there.
so you can
Pick
purchase
and
it.
choose
Right.
which type of stock that you want to invest your money in
Right.
based on the type of return that you're looking for.
Gotcha.
So that's basically the stock market and how the stock market operates. Now, mutual funds. So a mutual fund is like having a basket of various stocks. So it goes to this, so it goes, so this is where the saying, don't put all your eggs in one basket.
Mhm.
So when you are buying a mutual fund, inside of that basket has various things inside of it,
Various stocks.
various stocks. So God forbid one company, right,
Collapse.
was issued a stock, did something crazy, like Musk started getting into a situation and his stock started taking a dive,
Something, right.
so that could be the act of the company
Right.
can cause the value to go down.
Right. Right. Right.
It could be someone said something wrong, like, or behaved inappropriately, as Musk did, right? That caused the stock to go down. But then again, there could be a recall on the product itself actually malfunctioning.
Right,
So,
right.
and consumers,
It could be various reasons why stocks plummet.
correct.
Right? You don't want to be caught in a situation where all of your money was tied up into that one
One
stock.
stock,
I get it.
then yes, you get wiped out.
Right. You
It's
get wiped out.
always, yes, so it's always safe to go buy a mutual fund where you have all different companies in this one stock. So if in this one mutual fund, so if a stock fails, the value of the mutual fund remains solid. So a mutual fund could have 100 different companies, and then you have different types of mutual funds. So you could have different funds that focus on technology.
Explain that.
Well, so when I mean when I
So,
mean
so the type of stocks that, okay, I get it. Just like you use Tesla, for instance, right? So that'll
mm,
be for automotive and innovative ways of what Tesla is
mm,
doing, right? And
right,
another stock I can have with, let's say, IBM, which is technology.
it's technology.
Okay, I
Yeah.
understand now what you're saying.
And it's all based on what the person is trying to achieve.
Right.
Yeah. So like so for example, when you're when you're going to be investing in the stock market, they always the advisor would ask what's your risk, what's your level of risk.
Okay.
So, and that's always based, and that always comes down to the question comes down to like an age, what age you are, and what is your experience in investing. So, if you're older and you're closer to retirement, and you have your X amount of dollars, and you're closer to retirement, most people will find themselves low risk to mid risk.
Okay.
But if the person is young in their 20s and they have time to recuperate whatever risk they're taking, then they will go into a high risk category
Right.
because whatever it is, they still have time to recoup.
Right.
But if you are 50 and you're going to go high risk and something happens, then you don't have that much time to
Right. To
recoup
recoup.
from the market.
Mm-hmm.
So yeah, so you got low risk, mid risk, high risk. And that is a question that the advisor must ask before you make that transaction.
Right, because they will be able to instruct you on where to put your money,
They have a responsibility. Their licenses are at stake.
right? So right.
Yeah, their license is at stake. It's not you lose your license. It's you better come up with a very good explanation for giving bad financial advice. Yeah, Securities Exchange Commission, financial industry regulatory authorities, they're the watchdogs, making certain that everyone who has the licenses, as a financial advisor, uh, operating in the best interest.
Yeah, in integrity.
Yeah,
Yeah,
fiduciary.
yeah.
Yeah, so
Interesting. Okay.
mhm.
All right. So you went over mutual funds,
Mhm.
stocks, and bonds. Where are we moving on to now?
Um, we can talk about the Roth,
Yeah.
and everybody needs to pay attention.
Okay, we're paying attention. We're talking about Roth IRAs, right?
Correct. Mhm.
ROTH.
Best vehicle for retirement. it grows tax-free.
Wow.
So you compare your Roth to your 401k, which is what every company offers, a 401k. So the 401k really, it's something that the companies use to entice people to come to work for them because it's supposed to be part of it.
Stay on target, and then we could break down what the 401k is.
Oh, okay.
Said that I can pay for my Roth through my 401k. Explain.
No, the Roth is outside of the Roth is out, it's an independent
I
retirement.
understand that, but you said something, you tied in the 401k to the Roth. How did that work?
No, so but
Okay.
the a company every company offers, or not every
A
company, most companies
401k,
offer the
right,
401k plan,
right,
right? Which it's a matching plan.
right.
So whatever percentage of that is put aside, they're matching, you put that amount there for them. And when you retire,
So a 401k plan, I'm gonna slow it all the way down. A 401k plan is a retirement plan that you can get through your company, right? So it's a place of an employment. And usually what happens is for the individual, the company matches what you said that you were gonna take out this 401k
out of your salary.
out of this salary, right?
Hmm.
So if you say that I'm gonna put $50 out of my
Hmm.
salary to my 401k, the company will match your $50 and contribute that as well to your 401k pool, right?
Correct.
And okay,
So at whatever age you decide to retire, remember that is pre-tax money. It has never been taxed. So you're actually in business with Uncle Sam to grow that money. And when you do retire, Uncle Sam wants the piece of that investment.
right.
So when the 401k plan, if everybody's looking at the 401k plan and they see I got $100,000 in it, just remember you're not getting all of that. Now, unlike the Roth, when you have your Roth, that is after tax money.
Okay, we're gonna stop before we jump to the Roth, right? We're back at the 401k plan. Now, once you retire,
Mm-hmm.
you get the money that you agreed that would be the amount of your 401k plan. So if you say it was $100,000 at that time,
Mm-hmm.
however, the they're gonna come and get their
Uncle
tax.
Sam. Uncle Sam.
Uncle Sam is
Mm-hmm.
gonna come and get a portion of that.
Right.
Okay, so I have a question. If I was working with MTA and I had a 401k for, let's say, 15 years,
Mm-hmm.
but I didn't come to retirement before I left,
Mm-hmm.
right?
Right.
What happens with that 401k?
You mean the month before?
Yeah, I didn't retire yet from MTA,
Mm-hmm.
but I left. I'm no longer with the MTA.
Oh, okay. So you can, that money normally is left. Some people leave it with the MTA, and whichever company is supposed to be managing it, because most 401k plans, they're not really managed to the with the type of consistency that is needed to see if that the stocks that it is invested in, if they are the right stocks at that particular time, or if they could have put it someplace else better.
So what would that mean to me? Now I
But
have
so you
vested.
had so if it's sitting there where it's at and you moved on to another company, right? You can roll it over to someplace where it can be managed.
That's what I'm asking.
Yes, yeah. So, and it's so most people that it's they just roll it over to a company to manage it. So you find some people have worked 3, 4 different jobs, and they just left their 401k plan and it's sitting there, but it's not actually performing the way it should perform. So what you do is roll it over to a company that is actually going to manage it and make certain that where they're putting it is giving you now the highest return on your money because they're managing it.
But that too comes at a percentage.
Yeah, it comes at a percentage, but it
At
needs
least
to
it's
work.
making something, it's just not sitting.
That it's just sitting down there and not making you any money. Because the whole purpose of his investing is to make money in return. It's not like having your money sitting down there. You might as well just take it and put it under the mattress.
Right.
Or you could leave it in the bank. So, but yeah, if you have, the 401k plan is sitting down there and you're only getting 3%, and it could be moved and managed someplace where you're getting 7%, then the whatever the percentage it is to pay the person who's going to manage that, you're still going to come out winning.
Okay. Okay. All right. So now you went back to saying something and I cut you off about a Roth.
Yeah. So we were talking about the Roth as being. I was about to say that the Roth is the best place to put after tax money. Meaning, and it really works good for gig workers. So people who are like people who get tips,
Okay. Mm-hmm.
right? That's the place for them, because most of the time they're self-employed. So they don't have a retirement plan. So in a situation like that, for them, they could establish, their own, individual retirement account.
And so
Right?
entrepreneurs.
Right, entrepreneurs, right. And that's where they're contributing their after-tax dollars towards, their investment. Right? Those contributions, they can grow tax-free up to the age of 59 and a half years old.
So what happens after I'm 59 and a half years old? Now I start getting taxed on my investment?
No, no, not really.
It says, I'm tax-free up to 59.5. So what happens
So
when
that's
I'm,
when you know when you can no, I mean we're talking about withdrawing.
okay,
And so and it has to, and it's not just up just 59, it has to have been open for at least
a certain amount
5
of time,
years.
right, okay.
So it's definitely, for gig workers and people who get after tax, who get, you got your side hustle. And you want to make certain that money is working for you towards your retirement. Cab drivers, people like that, they,
Mhm, mhm,
they can use that vehicle,
mhm, mhm.
and every year you have a maximum amount, 65, depending on the year that you are. There's a cap as to how much
You
money
can invest
you can
into,
put. Yeah.
okay.
What are we gonna do next?
What's the word? Well,
So okay, and so we 401k and the 403b.
okay,
So the 403b is for normally nonprofit organizations offer the 403b plans,
um,
and you would always find them.
those are stock options through the,
Oh, no, those are retirement plans. There's a
okay,
retirement plan, but normally they're given by
nonprofit.
nonprofit organization.
And what's the difference?
Between the 403b plan.
Yeah,
Well, you besides the besides nonprofit, it also goes it's for public education organizations as well. You
okay.
also have hospitals. They offer that as well, and also,
Libraries?
right, of course, libraries and ministries. I think some churches do have a plan set up like that for clergy
Okay.
as well. Yeah, so
What is real estate hmm, if you could tell us briefly,
about real estate.
about real estate?
Uh, okay, so real estate, basic real estate is you could start with land.
Mhm,
Land is real estate. Then you have structures that you put on top of it.
mhm,
So that could be a house, which is residential. You have residential real estate. So there'll be a house, a condo, um, a multifamily building, right? For family and up, all the way up to 100 or 100 apartments, or a tower. That's real estate. Uh, then you
Can
have
it be commercial?
commercial. Yeah, you're getting into commercial real estate. It could be um, it could be a store. So then you have mixed use. So let's start with mixed use.
Okay.
A mixed use building, which you would see like you go down along Flatbush Avenue or
Mhm.
Church Avenue. There's a storefront on the first floor, and there's two apartments above it, or one apartment above it. But any structure you see that has a storefront on the street level, and apartments on top of it, that's mixed use building.
Okay.
Right. Then you could also then you have a warehouse. That's real estate. A church is real estate. Schools are real estate.
So churches are commercial?
Churches, well, because they fall under that nonprofit status, we wouldn't say that it's commercial because
I got
of
you.
that tax exempt
Private, but
status.
not, right,
Yeah,
right.
they're in a specific area, but
Okay,
it still is falls under the definition of real estate
right, okay,
because it appreciates in value. So you could say, yeah, real estate is a type of investment that should appreciate in value, but you do see, based on the fact that how many people have started work from home, that commercial real estate is now risky
mm, mm-hmm, mm-hmm,
because the storefronts are suffering financially.
right.
And another thing that is impacting the value of commercial real estate is Amazon, that is delivering everything that people need to their home. So now there is no need for people to go
Or into the
out
state. Mm-hmm,
or go to even malls, uh, finding themselves in a challenge.
right,
So they are constantly trying to find innovative ways to attract people in. So like you could go to, one of my guys is a DJ, and he plays in the mall. So they're using whatever it is that they figure that could attract people in, just so that, they can keep out of the red
right.
in stores here.
Also,
So there is that the Great American Mall in New Jersey, you know.
yes,
My son loves to go to that one. There's an amusement park in there.
yeah, yeah,
And
oh, it's phenomenal, yes, yeah.
phenomenal, and he just likes to go in
Yeah,
the
you could go
water.
just hang out for the day, yeah.
Yeah, but there's it makes the waves inside of there,
Mm-hmm, mm-hmm,
and there is another section where you can go skiing
right,
down a
right,
slope. So, so everybody's figuring out all different, they have an ice hockey rink inside of there. So
right, right.
anything that they need to do to make certain that the value of that real
That
estate,
space, right, yes,
yeah.
yeah.
So that's real estate for you. Um, you know,
Why is it, in our communities, we never had the conversation about why is it important for us to own real estate? And this is the reason why we get trapped into staying in apartments or it being easier or blah, 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 blah. Talk to us about why real estate is, American gold.
well, real estate
Why
and
should somebody younger look for an investment property versus an apartment?
why
Why?
should somebody younger?
Yeah, why should somebody younger?
Well, I think
Instead of
that
moving out of your mother's house and paying, as you said, $2,300, why not look towards that being something of a condo experience? Or why talk to, you know what I'm asking?
I think it's lack of education.
So we're educating, we're educating, and we're saying
Right,
that
yeah. Right.
why is it that we should?
Right.
Now you're educating now.
Right. Well, okay, real talk. No one take offense. This is just real talk. A child grows up in a house owned by the family, generally understands that, and once understands it, as long as the parents explains it to them, listen, this is what it is. We invested X amount in this house for you to have this. You know, this is the lifestyle that we want for you. And once this lifestyle is something that they appreciate and desire, they would want the same thing for their children, so that they're geared up to wanting it and to aspire to achieve the same thing what the parents have achieved.
Can I say something?
Go ahead.
All right. My parents own this house, right? And they've went through all kind of turmoils to keep it, right? This is what I see.
Mm-hmm.
You know, what my parents told me is, this is for you, you know, after we gone, you guys get this. But all my life, I've seen that thing has been a money pit, right? In one way or another. They had a roof, the boiler, the place flood, X, Y, and Z, whatever.
Mm.
I just didn't grow up with an ideology on how this would benefit me versus after my parents die, then I sell it and make money off of it. So talk to me
Mm.
about the reason why I should, again, own my own and
Home.
and looking at it as a futuristic investment, right? This is, as you said, this is real talk.
Mm-hmm.
You know, I'm not coming from an ideology. Yeah, I grew up in a home. I understand what it takes, but I'm not interested. And this is where we lose a lot of our people
Mm-hmm.
just in that same thing. They see how expensive overhead costs are, but they didn't have the right conversation and let them understand
It's an investment here.
that it's an investment and that it does grow. It does, the investment does mature. The investment does, you do make money.
Right, because
The interest, you do make money off of the interest, and there's other perks, right? There's perks like you can take out of your principal to make repairs or whatever. There's things that you can do.
the fault is the parents.
Okay,
And
but
like
that has nothing to do with where we at now. We're
where
not
we are
punching the
meaning.
figure, we're moving forward, right? It is. There's a bunch of people in our community that prefer to rent versus purchase.
Right,
We're
because
here, so we're here now, and we're telling them, why should you? Why should you get out of that mindset of renting and now move into home ownership? What's the benefits?
the parents' fault. You may want me tell you why?
Phil, but we not addressing that. You got to move past
Yeah,
that.
but no,
It doesn't matter whose
yeah, but
fault it is.
yeah,
We got
but the
kids
whole
out there
fact
that
is
are
that,
listening to us,
well,
and they want to
and I'm
know.
gonna real talk. It's the
Yeah, but
parents'
it
fault,
doesn't matter. It doesn't matter. We
because
got
I,
people that's
from
going to be on.
experience.
There's people that are listening to us right now,
Mhm.
and I'm asking you to
Why
talk to them
they didn't do
about.
what they didn't? Why? So the question. All right, let
Stop.
me say the question.
Listen. I'm asking you,
Mm-hmm,
right, to talk to the younger generation
mm-hmm.
or to the older generation, to talk to anybody who doesn't have the information, Regardless
Okay.
of why they don't have it, they don't have it,
All
right?
right. So they didn't have it. I'm going to give you the reason why you need to have it. Is that
No,
what
not
you want me
the
to
reason why
explain?
you need to have it, but what's the benefits? What's the benefits in home ownership?
Right, which is the reason why they need to have it.
Oh,
Benefits.
right.
So the benefit of home ownership,
Uh-huh.
several things, is that you have something that you can pass on to the next generation. Now, if so, how does that matter?
How does it matter to me?
That how does the no? We're talking about so
How does that matter to me? Because the reason
creating
why,
generational wealth. That's
so
when I teach my home ownerships workshops, I always start
it's
about
a sacrifice for the future.
generation. No, not just that. Generational wealth. It's the
I
key.
get what
These
you're
are the
saying.
keywords. Generational wealth.
I understand what you're saying, but generational means futuristic. So it's something that I'm doing now for the future.
But you're also enjoying it.
So talk to me about what that means. What does enjoying my house mean? What
Well, I got my
does
house.
that mean?
I got my house. As long as I'm paying my
Mhm.
mortgage, I get to enjoy it. No
And
one
what
can tell me what to do, how loud to play my music, what color to paint my house, all of those things. I can tell who can come and who can stay. And that's what you call you have control over this, right? Different from an apartment where you're renting that apartment, and even though you're paying a rent there, if the landlord says to you and gives you way enough 1 year, 2 year warning that I'm going to be needing my apartment because my children are graduating from college and I'm going to need that apartment, you have to move. You
right,
don't own that house because
right.
the landlord has the control who stays and who goes. And this is what is happening to a lot of people right now because nothing was set in place for them, right? Because many of the people that I'm buying, I'm in contract for one person right now, and their thing is this is for my son and my daughter. They have some place. At a certain point in time, we are leaving this for them and we are going to go someplace else. That's a game plan. They set that up for their children. Even that person right now, even the son is 12, and the son wants to go into business to flip houses at 12 years old. This is stuff that he's always been wanting to do. So again, whatever the parents, as the parents, and they have this project and they're taking the kids out shopping to all of the different places to see what tiles, what this, what that. So it's now a project for the kids. The kids are learning home ownership and
I ain't
property
got no kids.
management.
I don't
Huh?
got no kids.
You don't got no kids?
I ain't got no kids.
It's all right. So if you're a
How is
person,
that gonna benefit me?
okay, here's why. When I meet a person that said they don't have any kids, my question to them is, are you planning on what's going to happen when you retire?
Okay.
Uh, what are you going to do when you retire? So in owning real estate, when you retire, based on your financial needs and you have paid out the mortgage, you've owned that house free and clear, you burn the note. If there are situations when you are low on cash, you can do a reverse mortgage where your house will put you on a salary and it will help pay for some of your bills. And you would not have to be worrying about going to a nursing home in your old age because property values keep going up. So even though your house is paying you a salary, the house is still appreciating in value and you will always have your needs taken care of.
How does
That's
that
a
reverse?
reason for someone.
How, how
To
does
take the
that
person.
reverse mortgage even work?
The reverse mortgage works like this. You bought the house for $300,000 and the house is now worth $700,000. And based on your needs and your age and that you have to be 62 years old to do a reverse mortgage. And if you If you're at 62 and you plan to live to 90 and you want to pull $1,000 every month to take care of your bills, because you have taxes and you have lights and all of that, then you get that check in the mail every month.
Okay, and that comes off of what you've made on the
That
house.
comes out of the equity. And that's the reason why you buy real estate. You invest in real estate to be able to tap into the equity
Mhm.
so that now you'll be able to do whatever you want. If you wanted some money there to
So-
open up a business, you
Right.
can tap into your equity. If you want some money out of that equity and the house across the street is being sold and you can buy that from the owner across the street directly at a discount, you take the equity and you snatch that deal. Equity. That's why you buy real estate, equity. And a lot of things people use out of their equity to help their children go through college.
Right.
Those are the reasons for that. So you can open up a business, educate your children, or real estate, or invest in another piece of real estate, or you can do a reverse mortgage to take care of your needs in your
Elder years.
elder years.
All right, we're gonna wrap.
We're gonna wrap. Okay.
Yeah, we shouldn't have talked about real estate. I may cut it just before we spoke about, but it was on the list, so I said let's go in.
But yeah, it was just we could always come back because when we go
Yeah,
back
we're gonna come
into
back. Oh, I didn't even stop it. Let me stop it.
yeah.